Hey traders, this is Stefanos on behalf of Tixee, and in today's video we'll be giving a look back of the market for the week of the 9th until the 13th of May. Before we dive into the webinar, some of the key highlights were of course the earning reports of Shopify, Beyond Meat, as well as Disney, and the price behavior that followed thereafter. As always, please note that all of the ideas discussed in this webinar are my own opinions and do not make up for any form of investment and trading advice, neither any recommendations to buy or sell. You should always do your own research and due diligence before buying or selling any securities, financial products, or instruments, and whether you use any kind of trading strategies. Any information that relates to past performance is not indicative of future results. So we'll be kicking things off with stocks. Like we said, these three names we're going to be covering today are the stocks that we covered in last week's Outlook, and obviously the ones that we're focusing on throughout the course of the past week, since they're going to be releasing their earnings. So looking at Shopify first, as you're going to see from the chart, things are not looking that great when it came to the earnings report. They missed both the earnings per share as well as revenue estimates. The former by 67.68% and the latter by 3.21%. As far as the timings, the figures were released on the 5th of May ahead of the market open, which meant that with the open, on the same day, the share prices gapped down by more than 16% or $78 per share. And we can see from the chart here as well, this was the day that basically the earning report was released, and as it was negative with the open, we can see that we had a gap down from the previous day, which again was by more than 16%, and we can also see the continued decline on the days following the report, which again we can see the strong impact of the earnings report. The prices did try to recover, and they did manage to recover part of that decline, but I would say I think it recovered it like almost 50%. So yeah, it's still a pretty significant recovery, but still let's not negate the fact that it had a pretty steep decline on the days after the report. The next one was Beyond Meat, which suffered a similar, if not the worst, fate to that of Shopify. It did miss both the EPS as well as revenue estimates as well. The EPS was missed by 62.81%, while the revenue estimate was missed by 2.62%. Now the company released the figures on the 11th after the market close. So you can pretty much see that here was the market close, and then the figures were released. So with the open the very next day, which is this candlestick here, we gapped down all the way down here. Now the gap down was by almost 20% or $5 per share. Prices did try, and they did manage to recover part of the drop. However, if we look at the bigger picture, it's been overall down by quite a bit. It's had 5 consecutive days in the red, and if this stays below the gap down, then obviously it's going to be the 6th consecutive day in the red. And then lastly, we're going to be looking at Disney. Now, although it didn't have a stellar earning reports, it did do somewhat better than the other two names. The EPS was still missed by 9.08%, but the revenue estimates were topped by 1.09%. The share price, as we can see here, this was the day that the report was released. The day after, we did gap down quite a bit, but it managed to recover most, if not almost all, of the previous day's decline. So yeah, this is with regards to stocks. We're going to be moving on to Forex now. And actually first I want to have a look at the dollar index chart. We can see that the dollar has continued its advance, moving to new highs with the passing of each week. Now if we measure this is pretty much 6 consecutive weeks in the green now, rising by more than 6%, close to 6.5%. We've been having more and more hints about further rate hikes, so one can understand why traders and investors are probably piling onto the US dollar. The Fed is also now probably considered one of the most aggressive amongst the world's central banks when it comes to monetary policy and battling inflation. So as we said, it enjoyed the 6th consecutive week in the green. And as such, I think almost, if not all, of the major currency pairs have been down against the US dollar. Some of the hardest hit were the pound dollar, which we're going to be looking at first. And actually, I'm going to switch this to the weekly time frame for this one. So the pound dollar is now on its way to posting a 4 consecutive week decline, shedding almost 7% or 856 pips. Which again, I mean, okay, it's 4 weeks, which is a month, but again, 856 pips for a currency like the pound dollar, it's, you know, it's a pretty significant move. I mean, if we switch on the monthly time frame, I'm pretty sure we won't see any kind of candlestick like the one we're gonna be seeing now anytime soon. So, I mean, these 3 months, frankly, have been quite bad for the pound dollar, which is, it's dropped quite significantly. But as you can see with the previous months, it hasn't been as strong. So this is definitely something that you wouldn't see that common happening month in, month out, but it's something that we're seeing currently and over the past 2 months as well. The next one is the US dollar Swiss franc, and I'll switch it on to the weekly time frame again for now. Now similarly, the US dollar Swiss franc, obviously because the US dollar is the base currency of this occasion, it has risen by quite a lot. As we can see now, this is basically its 6th consecutive week in the green, rising by almost 8% or 758 pips. And then lastly, the most impressive of all of the major currency pairs was the US dollar Japanese yen. It's risen, it has had 9 consecutive weeks in the green, and it has risen by more than 13% or 1,573 pips, which is again quite a staggering move. It did give back some of those gains, but again, this is pretty much nothing compared to the advance it has enjoyed. It's just a mere minor pullback. And this is going to lead us to our next and final asset class, which is going to be oil and gold. So with the steep rise of US dollar, we can understand why the prices of oil and gold may have stagnated or even declined. So looking at oil first, we can see it's been stuck in this range for, I would say, the middle of March. So it's pretty much been 2 months out that it's been stuck in this range. It is obviously trading above the $100 mark, which is quite a significant level as well. Let's not forget though the article that we had with regards to the EU imposing a total ban on Russian oil imports, which could mean it could be the catalyst for oil prices to move even lower. Then switching on to gold. It's been even more prominent, the inverse relationship between the US dollar and gold. As you can see, it's now on a 4th consecutive week in the red, losing as much as 9% over the course of these 4 weeks, or $66. So again, the inverse correlation between the US dollar and gold can be seen somewhat more strongly than I would say with regards to oil prices and gold. So yeah, this is pretty much with regards to the look back and review for this week. I hope you enjoyed the video and you found it useful, and I'll catch you all in the next one. Until then, trade safe.